welcome to India Market Open. It's 15th March and I guess we'll all remember that day or remember today. It's a very, very busy morning. Lots of reaction, traders, investors, news channels, lots and lots of stuff happening. But I think, guys, I think the last few weeks have been about anticipation, nervousness about what the outcome is going to be.
Yeah.
The day is today, but it seems like, is it going to be take a break now that the reactions are here? Will we react negatively? Or will we just say, okay, we're done now, let's move on?
Yeah, well, Brutus and Caesar certainly remember 15th of March. So, yeah,
it's been a day of deadlines.
Yes,
deadlines met.
Crazy.
So electoral bond details are out, number one. Stress tests are out for most AMCs.
Yeah, a lot of them, yes.
We'll be rating and grading them. Not all have done very well. Some have done relatively better. It's all on, the bell curve.
Bell curve, exactly.
So we'll see who's done well, who's not. Fuel prices have been cut, also widely anticipated. That's happened and, effective from today. I'm just asking now that the decks are cleared. The EC is also, quorum is full. Election dates today?
Yeah, election dates today, advanced tax numbers tomorrow. It's going to be as busy a weekend as the last 12 hours have been.
Correct. Now the question is, what does all of that mean for you this morning? So a lot of events. We need to break down implications for stocks you may have on your portfolio, on the market sentiment as a whole, and a lot more. So we're going to do that over the show this morning. Let's start with what the global cues are. Global cues are largely mixed, and US markets have actually taken a pause. They have snapped that winning streak because of the PPI figure. That's the Producer Price Index. Think about it like the wholesale price index for the US. So it's come in hotter than expected and by a fair bit. So 0.6% for Feb. Expectation was 0.3%. You've seen that in the way stocks have closed yesterday, and we'll just pull that up for you, including the futures, to give you an idea of what's happened. Even the core figure has been higher than expected. So core PPI, when you remove food and energy, has come in at 0.3% versus an anticipation of 0.2%. That's impacted the bond yields, the 10-year inching up at 4.28 when I checked last. Yeah, 4.28%. So that pain is going to be showing. Crude is another one that I must mention because crude prices have consistently been going higher. Good time actually for Indian consumers if the government gives a little bit of relief, though it's mostly election linked. So $85 per barrel is where we've reached on the Brent. Two factors: the continuing Ukrainian drone attacks on Russian oil facilities, and secondly, the inventory levels in the US are, lower than anticipated. So that's what's impacted crude. Quick look at how Asia is faring. Did not open too well. It was in the red and continues to show pressure. So, I just want to very, very quickly go through the fund flows before I hand to Niraj. So if you look at the global cues, not very positive from that end. But the fact is that we had a great day of recovery yesterday, and it is interesting to see who actually bought. FIs continued their selling spree, about 1,300 odd crores. DIs didn't buy too much, 139 crores. Safe to assume that the retail investors came in short covering as well?
Yeah, largely short covering. Just a point though, I think what worries me a little bit is crude price behavior because of what's happened currently.
Yeah.
So we are looking at a month of April and May wherein the US liquidity issues will come to the fore because of all the withdrawals that they've done. A lot of articles around how April, May could be the litmus test. So we have a bit of a liquidity squeeze in the US coming up. If crude prices spike in this period at a point of time when commodity costs for most companies will also start inching up relative to April, May, October, November, December, and sales growth doesn't quite perk up, we are looking at possible commentary of margin squeezes, macro stress if crude spikes up further. I mean, 85 is okay, but what if it does 90, 95, 100 in thereabouts in commentary? So I think there's a bit of an issue around a point of time when the markets are not at their best, as the market showed on Wednesday. So some stress may be coming up. Who knows? Any thoughts?
Yeah. No, so crude will be a big factor. I absolutely agree. But I think domestically right now, the focus is on a lot of stuff going on for us.
Most certainly. Okay, so very quickly the trade setup before we move on to the key talking points today, because there is electoral bonds, stress test and OMCs, all three to watch out for. So the surprise pullback, and I call it a surprise pullback because nobody anticipated what would happen yesterday. So it just kind of thwarts the out and out bearish trade, but caution, most people are saying still advisable. I mean, just look at the put strikes and that shows you how evenly spread the bets are. Yesterday, 21,700 was that key point. Now that's moved to a range of 22,100 to 21,900. Look at those option contracts out there, 1.57, 1.34, 87 lakhs. It's bunched up in a broad range for the Nifty. And I call it the broad range for the Nifty because the Nifty isn't moving much in the last few days. It is mainly the broader end of the spectrum. Banks not participating yesterday was a bit of a puzzle because they showed strength and resilience on Wednesday. There's the expectation of this FTSE rejig inflows coming in. One would have thought that if the Nifty were to be up, banks would lead it. Banks did not. And therefore, that remains, to my mind, a key sector to be watched today and how it behaves. OMCs should correct. I mean, I will talk at length about it, but OMCs naturally would correct it. So that's a sector. And, you know, the stress test disclosures, at least the ones that I've seen thus far, the 3 AMCs that we saw last night, not alarming.
No, and they're all in line, except for DSP, which came in at 32 days for small cap. Axis, Nippon and Quant for the small cap fund liquidation, 50%, is only about 22 days.
Yeah. So, yeah.
I don't know about only. 22 days is a little worrying.
That's a global average, actually.
Yeah.
But
And you have to understand the regulator requires you to have at least 65% in small and mid cap if you are a small and mid cap fund. So I'm not sure how that could improve substantially in a small cap space, right?
No, sorry.
No, my only point was if you compare it to, say, an Edelweiss, you can compare it to an Aditya Birla. So, like I said, on the bell curve, if you have others who say they can do it in a shorter time, does that reflect negatively on you?
Yeah, so I just have 2 quick thoughts here. One, people who invest in a small cap
Are aware
fund
of the risk.
should invest with a belief that there will be a slightly more risk than what will happen otherwise, and therefore anticipate more returns. I mean, probably one reason why quant small cap funds have really shot through the roof, right? They've done
It's
really
high
well.
risk, high return.
They've taken a little bit of risk. Also, just the larger point is that, I mean, the stress situation is when only 10% of the market participation is available to MF schemes. 10%, right?
So 90% is
10%. Right now, volumes are probably 2 or 3 times averages. So yes, you argue that stress test should be accounted for the whole year, what will happen in the future, etc. I'm talking about the current situation since they've released the stress test as of the last 10 days or as of yesterday or whatever you call it. We know volumes are high. We know participation will be high at the current point of time. Versus a 10% stress situation, volumes much, much higher. Somehow I thought that the results were okay.
I just want to take back to what Ajay Srivastav told us yesterday on this show. If they come and sell, who will buy these small cap stocks? Are they the buyers?
Yeah, well,
and that's really the question at the end of the day.
Which is why, but the point being, so if we are looking at 22 days for the entire liquidation, so the 50% of the liquidation, at a 10% market participation, the only point is, with the market participation being above normal right now, would they be able to liquidate in a stress situation easily relative to what has been? The answer seems to be a yes. And therefore, people, my limited belief is that people who will be flocking to some of the schemes wherein the number of days taken for liquidity are higher will go in with the belief that I will possibly get higher returns and I'm comfortable with that portfolio.
So I think it comes from a place of warning and telling investors, making them aware of the risk that is involved. It's not past performance, it's the fact that there could be, in a case where there's a liquidity worry, this happens. But also look at individual portfolios. Very rarely will you come across an investor who's got 100% portfolio in a small and mid-cap space. So if there is liquidity pressure, if there is an individual liquidity requirement, you may seek out liquidity from a large cap fund. You may not go after a smaller mid cap fund. So in my opinion, while this is good to know, I don't think it's going to be damaging in any sense from here on.
At the end of the day, the regulator wanted more information and transparency and awareness, and that has happened. So that's a good thing. Maybe initially for the first set of numbers, there may be a bit of trepidation, but then it will be normalized.
And I think another worry which comes to my mind, which is not from which is not so much from the number of days, is the size of assets. The bigger the AUM, the tougher it is to be nimble-footed, right? So I think that's one thing that market participants need to be concerned and wary about in that sense. When you're investing in a small and mid-cap fund, you don't want it to be too large, because if it's too large, the fund manager doesn't have the ability to go out and sell as aggressively or actively. The other thing on Nippon that was a good sort of point out is they'd stopped accepting lump sums all the way back in July. Yeah. And if you look at inflows into mid and small cap between April and May last year, 70% of flows were going into small and mid cap stocks. As of Jan and Feb, the numbers dropped to 30% now. So while it looks okay, I don't think it's going to have much of a material impact in that sense on the markets, at least this morning. But you know, we've been talking and we've not had a chance to look at implied Nifty. A quick check on what that is getting up to. It was a great sort of technical pullback for the bulls on the street yesterday. It looks bad actually, 108 points. Niraj, you want to come on this one? 22,100 I think will be important in terms of support. Look at you guys, you're causing the crash. We are causing the crash.
I'm wearing pink.
Shade of red, shade of red, a little bit of white mix.
No, and you also have Bank Nifty weekly expiry.
But yeah, but with the global markets, just the way they've been.
So there are a few things. There's global markets, maybe stress test, people are looking at it, you know, initially with not so much of positiveness. And the other big thing is really the electoral bonds. And we're going to come to that in detail. But Samina, you want to just, are you done with your trade setup?
Yeah.
So
very quickly on OMCs, there has been a fuel price cut, unwarranted but not unexpected is what the big brokerages are calling in. Petrol and diesel prices have been cut by 2 rupees as effective from this morning. This comes in well timed just before the model code kicks in. This is going to impact GRMs. The stocks will also be reacting negatively. HPCL in particular will see a hit. Remember, diesel GRMs, marketing margins, have not broken even just yet. So any sort of fuel price cut is going to have a negative impact, a bigger impact on diesel play. HPCL, BPCL, IOC, 3 stocks to watch out for. Brokerages believe it wouldn't be a surprise if the fuel price cut gets revised back upward post-elections. But what's also very interesting to note is while this announcement came in, crude prices were trading at $85 a barrel. So there was no reduction in global crude prices. This is largely election play from what we understand. So unwarranted but not unexpected is the tagline for fuel price cuts. Well, that's one space, one very active space that we are watching out for. But the other factor you want to note with OMCs is brokerages do believe that while this has happened, prices will correct, but they're only going to make them so much more attractive. In fact, in the month of Feb, you saw a whole lot of mutual funds going out and buying stocks like HPCL, even when valuations for the broader markets were being questioned. So the price correction, the supply that will come in, will get picked up quite swiftly on these OMCs. Well, moving on from there, the few other names that are on my focus is NHPC and KPI Energy. KPI Green with PSPs in focus. Companies like NHPC have been signing deals with a number of state governments from Madhya Pradesh to Rajasthan to Gujarat. This is the second one in Gujarat with the Gujarat Urja Vikas Nigam. In fact, interestingly, we'll talk to the management on the show this morning to understand what this means for their top line, what this means for business at large. KPI Green as well has bagged a project from the Gujarat Urja Vikas Nigam. So same sort of order space for KPI Green and NHPC. NHPC will be on the channel very shortly, so we'll get a sense of that. But that's what I have, but there are a whole bunch of other and lots of other names that are going to be in focus. Electoral bonds, I don't know what this means for listed companies, but
there are a lot of listed companies in the list. First up, there are a lot of listed companies in the list, but it's not necessary that that's a negative, because these donations have been made over a period of time. They're not very large numbers. The largest numbers are from unlisted players, and frankly, it's not illegal to invest in electoral bonds. It was just that there was an anonymity which no longer exists. Having said that, and we're going to have a more detailed report in a bit of what the implications could be, but just in the stocks to watch list, I was picking up Electra Green. Electra Green because the second highest donor for about 1,200 crores in all is a company called Megha Engineering, which has actually won a whole slate of infrastructural projects, including the metro stations, Ojila Pass. Large player. They've given about 1,200 crores. Now, they have a controlling stake in Electra Green. It's a stock which will be on the radar. I'm not sure if it will react negatively.
Somehow, something tells me it might.
It may. It may.
Very expensive. Maybe that's why. Looking for a reason to sell.
I love it how you're looking for the fundamentals. The fact is that,
Tamanna, just come. Actually, let's come on Electra. The number of order wins they've seen. in the last couple of months, and we've discussed this, execution is going to be a challenge for them, and they've just been...
Today, the story is going to be going back and matching the date of donation, the buys of the bonds
and the order wins.
And the order wins. So this is a whole different exercise that is going to go on. May have some impact. If you have Electra Green, I think be nimble and alert on what's happening with it. Vedanta is the other one, only because it's in the top 10 of donors. Again, nothing illegal, nothing, to be very, upset or scared about, because it's a completely legal way until the Supreme Court struck it down. They've given about 375 crores. Vedanta has been through a slew of, I would say, headwinds in terms of other regulatory pressures. They're challenging a court order, etc. That's a different story. So Vedanta is one I would watch. Paytm is the other one, because, again, news. What an evening we've had yesterday. So Paytm has finally got the TPAP license from NPCI for their UPI payments. I would say, in a sense, the overhang is behind them. The worst is over. 15th is the day when everything that the RBI said had to come into action, and it's all been neatly tied in a bow to ensure that there is no issue for users on the ground. So Axis Bank, HDFC Bank, Yes Bank, State Bank of India have become PSPs. That means if you have a Paytm account, you can continue to do transactions. The backend will be handled, very simply put, by all of these. I would look at Yes Bank as well, because they will now be getting a bulk of the merchants that Paytm has. What does this mean? So there's a Jeffries note which says the NCI approval removes last remaining regulatory challenge. And whenever that big cloud moves, it could be a positive for the stock. Paytm was not doing too badly, even through turbulent times. For Yes also, it could be interesting. There's already been a hit to payments value and app usage for Paytm. That's as per the Feb 24 data, 8 to 15%. The business model is now moving to a pure payments company. So there will be a re-rating on what really the value of this company is. And they will have to dip into cash reserves for customer retention, which we knew earlier as well. But at least there is clarity now on what is left of 197 communications. So those are the few on the list.
Just very quickly, 2 or 3 more. So watch out for financials. Like we said, that today could be interesting. They didn't participate yesterday, but do HDFC Bank and other banks come in to flavor today, because brokerages expect about $1.5 to $1.7 billion of inflows due to the FTSE rejig. So watch out for some of the financials in the session today for sure, in addition to OMCs as a pack that remains firmly in focus. Watch out for a couple of these bulk trades. So Sundaram Clayton is an interesting one. While Venu Srinivasan sold, and that's a marquee name selling out or selling some of the shares, but SBI MF bought 7.74 lakh shares. More importantly, Govind Parekh bought about 5.35 lakh shares. As noted an investor in the country as they come, watch out for Sundaram Clayton. Could be an interesting one. Watch out for Gopal Snacks. Quant AMC is the buyer. They bought over 15 lakh shares at about 374 rupees a share. So Gopal Snacks could be an interesting one. Usually Quant's name evokes response. So maybe, just maybe, this one is in focus today as well. So these are a few that certainly stand out. There are some brokerage notes, like Morgan Stanley on Paytm is pretty sanguine after the development. So let's see if that one has a bit of a reaction. Tamanna spoke about it. So there are a few that you need to keep in mind when it comes to stock-specific moves in the session today. But, well, the big story, aside of OMCs, aside of stress tests, and viewers, we will talk about the stress test details with some pertinent people a bit later on in the show. But I think arguably one of the biggest and most anticipated things is also the electoral bonds data. And Tamanna, how do we dissect this?
So about 372 pages of a data dump hit the Election Commission website last evening. There are 2 sets of data, right? One is who has bought electoral bonds between 2019 and 2024. The other set is of the key political parties who received how much. So we're going to break all of that down. Obviously, there are too many names, many of them listed companies. We've sifted it as per the top donor. So let's pull up that chart first, and that throws up interesting results. Now, many of these are unlisted companies. Future Gaming is the highest donor, about 1,300 crores, 1,368 crores. What's interesting about Future Gaming is that it is a Tamil Nadu-based lottery and gaming company. Why is this important? Because you will remember that the Tamil Nadu government passed a law in its assembly banning online gaming. And you have Future Gaming donating about 1,300 crores. Now, we don't know who they donated to. We know the timeline, and it's a very consistent timeline of them making consistent donations because they're buying electoral bonds. Well, who got them? We'll have to wait and see. But this is one linkage or coincidence which will be made. Mega Engineering Group is the other one. A total, so it's a whole different set of names. We've collated all of them related to this one group, and that's about 1,200 crores. Mega Engineering Group has some of the largest infrastructural projects in the country across states and central government projects as well. Key ones, their listed sort of associate or owned is Electoral Green, which we spoke about. So Mega Engineering is another interesting play. Quick Supply Chain, 410 crores. Is an important player as well. A very cursory search will show that it is owned by a large conglomerate. So Quick Supply Chain is one. Haldia Energy is the other one, 377 crores. And, you know, there are more on the list. There's MKJ Group. MKJ Group is part of Mega. Vedanta, about 376 crore. SL Mining, the SL Group, also been in the news a lot, 225 crore. And Kevinter Food Park. A lot of these are West Bengal-based companies as well, which have come in. Like I said, the list is long. A whole host of listed players. Some of the biggest names, the Piramal Group, the Birla Group, Kota Group, all of them have donated in some way or the other. In fact, Dr. Reddy, Cipla, Sun, all of them have donated. SpiceJet has. Nothing illegal about donating, nothing wrong about it. So that I want to put up on the table. Now, 1,277 unique entities bought bonds worth 12,155 crores. The BJP received the maximum, around 6,000 crores. So that was top of the line. The second largest party to receive was not the Congress, was the Trinamool Congress, which received around 1,600 crores. So this is going to be interesting because as a regional party, largely in West Bengal, they have the highest second highest number of donations. The Congress has got about 1,420 crores. And then, of course, there is a list. The BRS is number 4, DMK. All the parties have received. Again, this is what electoral bonds were for. So at the end of this, you may be asking, what's the big deal? What's the implication? What's the market? And what is everyone going to be looking for? And here's where it gets important. Inferences will now be drawn between order wins and donations. There is going to be a match the following kind of exercise that a whole host of entities is going to do between what were the dates of the electoral bond purchases, what were the dates of the order win, and try and match them to when these bonds were actually gone and used and taken by these political parties. Attempts will obviously be made to establish links between any raids that have been happening and donations. So all of that will go on. The important bit is that these will be inferences because regional parties and locations of donors will be also matched. In which state is this company headquartered? And then you'll try and match them. People will try and match them with the location of the regional party who got electoral bonds. But the fact is you can only make inferences. There is no way to clearly say 2 + 2 = 4 because you know that bonds have been bought. You know that the money has been received, but who gave it to whom exactly will not be known from these data sets, and which is why it will give a lot of fuel to political fires, but may have no real impact apart from that. And at the end of the day, it's not really wrong or illegal to buy these electoral bonds. The time when companies bought them, it was perfectly legal to do, and the anonymity they had was part of the act. All right, what's the implication for the market is the question. I'm going across to Ajay Bagga first for more on this. Mr. Bagga, very good morning to you. Just to understand, is this something that the market is going to be watching and going through those names? Any real impact, you think, for the market sentiment today?
Not much, Tamanna. See, when you're investing in India, you are aware of this pilferage that happens. It happens by the promoters and it happens for paying the Neta Babu nexus. So it is largely factored in. Every now and then we see an infrastructure company coming out of nowhere and then you come to know that they are a front for ex-politician, Y chief minister. Those are well-known stories on the street, and you discount them already. So this is too small, 12,000 crores over 5 years for an economy of the size of India, and for the known corruption in India. This is a very small amounts. It's not market moving. It is a relief that, okay, this is done with, and let's move on. But it is largely factored in. You might get one or two small companies getting hit, but largely these are shell companies. Largely these are unlisted companies at the top end, the lottery guy and stuff like that. They might have some listed entities somewhere which you could see minor correction, but normally the institutional players will either discount it or stay away from such companies, knowing the stories. These stories are well known, and the amounts are very low for an economy the scale of India. And what actually goes into political funding, this is not even the tip of the iceberg.
Yeah. So in the bigger picture, this is a minuscule amount of what political parties actually spend on running elections. So where that money comes from is a whole different story. But Mr. Bagga, just to get a sense of, when there is a anticipation of a big event and it's finally behind us, it's also a relief. In a sense, it's positive, because if you look at the list, there are no big names of any big Indian conglomerates. Maybe there are related companies that are making donations, but there was a lot of speculation about which big names would appear on the list, and you don't really see that. Would that be seen as a relief?
Yeah, definitely. Definitely it's a relief. And again, I have seen FIs since 94, Tamanna, when they come in, they put that discount when they look at the Indian revenues, because that is the cost of doing business. So in the US, it's above the line. You hire lobbies who are openly paying the PACs for the re-election of the Congress people, their House and Senate, and even right up to the White House. So you go and fund PACs openly, and in India it is done below the line. That's the only difference. But this happens everywhere in the world. And we should not be self-berating that, these numbers. This was one attempt to at least bring it above the line. It has failed now with the court's intervention. Again, most of it goes below the line and we never get to see it. And that will continue to happen, and that's discounted in the prices.
Okay, so that's discounted in the prices. Then in your view, Mr. Bagga, what is the big factor today? Because there is so much news coming in. Petrol, diesel prices have been cut yesterday. Stress test numbers are out. Then you have the electoral bonds hangover now done and dusted with. People are wondering whether the dates will be next. So what's the biggest factor that market is watching this morning?
I think the big move is global, in terms of the US CPI, PPI coming ahead of estimates. Still a June rate cut, the market is hanging on to that. So the next Wednesday, Fed move will be very critical, Tamanna, and I think that will keep markets going up and down. Over the weekend, we'll get good advance tax numbers, and that should give some amount of, buoyancy that the earnings are doing well, both at a household level as well as corporate levels. You will see pretty good advance tax numbers. So direct tax numbers will come in much ahead of the budgeted estimates, and that should help. But mostly it's dependent on the Fed, the US inflation. And one key move, which till now I think is not fully discounted, is the Japanese wage number comes out, and if Bank of Japan changes its stance to move from a negative number and a yield control into raising rates, that is going to hurt the carry trade a lot. So I think that has still not got discounted. If something like that comes in, that could hurt flows globally, because a lot of money is raised in Japan, leveraged in Japan, and then invested elsewhere because of the rates having stayed in the negative territory for so long. That will be market moving. We have to wait for that.
Yeah, that is definitely going to be the big one. But thank you, Mr. Bagga, for joining us this morning with all of that perspective. So at the end of the day, it may turn out to be a lot of bother about, not too much as far as the markets are concerned. No doubt, the electoral bonds data is going to have far-reaching effects ahead of a poll season. Electorally, it is going to have, politically, it is going to have, it also gives the ruling party a chance now to say that, look, everyone was enjoying the benefits of electoral bonds. What was, all the hue and cry about? But the fact is, as far as the markets are concerned, this is something that is done and dusted with. So we'll take a very short break at this point, but our coverage continues on the other side. When we come
Welcome back. You're watching India Market Open. It was a smart pullback on the street, most calling it a technical pullback in yesterday's day of trade, with the Nifty, Sensex and the broader markets all actually ending in positive territory. Well, today is weekly bank expiry, and the cues that we're going to be reacting to are enormous, to say the least. So it's going to be quite a tussle between the bulls and bears, to say the least. That's the Nifty future trade. It's at 110-point premium, is an increase in open interest by 1.5%. On Bank Nifty, which clearly has been struggling over the last couple of days, but finding support at 46,651, which is the 40-day moving average, continues to see a massive jump up in a premium of about 220 points, but percent about marginally lower in terms of open interest changes. Well, in terms of the put call spread that we are seeing this morning, 22,200 is seeing the maximum call interest, open interest addition, indicating that this is going to be the immediate level of resistance for the Nifty in today's day of trade. That's followed by 22,500 and 22,300. Call unwinding was maximum seen at 22,300, like you can tell, and of course key levels of support remain 22,000 and 22,900. On the put writing side, what we saw was 22,100, so the maximum open addition, indicating that's going to be an important level of support coming in for the markets. That was followed by 22,000 and 21,900. So those are three levels of support that the markets will be seeking in today's day of trade. In terms of a trading range, we're looking at 22,100 to 22,200 on the upside. If 22,200 gets taken out, we will be making an attempt at levels of 22,500. So that's pretty much the open interest picture. The call and put activity focused and largely concentrated in that price band of 22,100 and 22,200. Stocks like MCX, MGL, NMDC and Dr. Lal's labs, Dr. Lal Path Labs, an increase in long built-up. You had short built-up seen in Shriram Finance and NMDC. In terms of stocks like Ultratech, PI Industries, Adani Enterprise and Sun Pharma, what we saw was short covering in those counters. That's pretty much what we have. Adani, HUL and Sun Pharma, which witnessed a sharp short covering in yesterday's day of trade. So all in all, it looks like it's going to be a tight trading range. Implied Nifty is indicating to a gap down, and it is, of course, your weekly Bank Nifty expiry. So lots of cues to watch out for. On Bank Nifty as well, 46,600 and 46,500 will be the crucial level of support coming in for Bank Nifty. Well, we have with us Aamar Singh Deol joining in now with his top trades. Aamar, morning. Thanks for joining us. Aamar, before we go into your top trades, what's the call on the Nifty? 22,200 seems like the immediate level of resistance on the benchmark, with support sitting at 22,100. You think that range is going to be respected today?
Yeah, a very good morning. And if you look at Nifty, I would say short term there is a loss of momentum, because if you look at Nifty over the last few trading sessions, we've seen it trading in a range, and on the downside, however, some very crucial support for Nifty is around the 21,850 and 21,900. That's I would say a sacrosanct level, very crucial zone of support. We are above that level by almost more than 200 points. So that's one point. But overall, if you ask me, if you look at the derivatives data, put call ratio also for the next weekly expiry, that's not very encouraging. But that keeps on changing. So it's currently around PCR for the next week. If you look at the monthly series, that's around 1.2. So that's monthly series gives some confidence that there's more of put writing which is happening. So otherwise, I would say it's more of a range play, and we'll have to watch out for some triggers which the markets are actually looking for. Otherwise, it could be more of a range play. If I look at Nifty on the upside at 22,350, 400, 21,850, 900 on the downside. That's a range. It's a trading range for Nifty as of now.
Aamar, let's talk about Bank Nifty, because it's respected and held on to that 40-day average of 46,700 in terms of support. And most part of the selling pressure has been absorbed quite well on Bank Nifty. Are you expecting it to break out of this range and move up? I mean, is there a bull trade over there for Bank Nifty? And of course, you've got your weekly bank expiry as well today.
Yeah, so if I look at Bank Nifty, we need to remember that the heavyweight, the constituents, how are they behaving? So because in Bank Nifty, HDFC, if you look at till the time we don't see HDFC trading over the 1470, 1480 zone consistently, I would say there would be some pressure. If I look at the other major constituent of Bank Nifty, and that's ICICI Bank. So ICICI Bank has also gone in for consolidation. After hitting record highs, it's gone in for consolidation. So these two major, they constitute almost more than 50% weightage. So there the triggers are not very positive. So it tells me that there could be some consolidation. Now, talking specifically about Bank Nifty on the daily charts, there isn't much, I would say, a strong trend. And if you ask me on the support levels, somewhere around 46,400, 500, that's a zone of support. Whereas on the upside resistance around 47,500 levels. So it's more of a range play in both Nifty and Bank Nifty.
Right. Aamar, I believe you've got a trade as well for our viewers this morning, and that is a bull call spread on BHEL. You want to take our viewers through what that is and your expectation on the price movement there?
Yeah, sure. So, see, what has happened in BHEL is that this was one stock which has significantly rallied. And now we've seen some very sharp correction. Because if you go back from almost 275 levels, it's around 220 odd levels. So there's been a more than 20% correction in the stock. The stock is at very crucial support zone. So there is a pullback which is expected. So one can look at a bull call spread wherein one is bullish in the market. So for the March series, one can look at buying a 225 call option, which is available at 8.95, and selling a 230 call option at 6.45. So where the stop loss is 0.5, the target is 3, and the lot size is 5250. So having a bullish view in the stock, it's more of a contra view because the stock has corrected sharply. But since the stock is at very crucial support zone, so a pullback is expected. Whenever we are into option strategies, it's very important that we also we are mindful of the time that we are holding the option. So you get an opportunity, you should definitely look at booking profits or exiting the trade. So this is one stock one can definitely look at as a trade.
Options largely time sensitive, like Aamar says, but recommending a bull call spread on BHEL. Remember what a bull call spread is: one long call with a lower strike price and one short call with the highest strike. So all you're betting on is the stock actually going up, and like Aamar said, a technical pullback cannot be ruled out on BHEL after the recent decline that the counter has seen. But thank you, Aamar, for joining us today. But back to you guys. It's OMC's in focus this morning again.
Most certainly. And you know, since there is no indication of any excise duty relief, safe to assume that maybe the price cuts will be borne entirely by the OMCs. Yogesh Patil, VP Research at Daulat Capital, with us on the show. Yogesh, good having you. Thanks for joining in. Good morning. Is this a sharp negative surprise, or is this a bit milder than what you might have anticipated?
So, good morning, first of all. And this is a sharp kind of reaction we can see on the stock side. First of all, just wanted to tell you, post these price cuts, OMCs are going to take the hit on their gross marketing margins on the auto fuel. And because of that, the gross marketing margins will get hit by close to 2 rupees per litre. Now, post this price cut, gross marketing margins will cut down to the level of 3.5 to 4 rupees per litre. Looking into the Brent prices, which has already touched the $85 per barrel, at this level, there is no cushion for gross marketing margins if the oil prices inches up from the current level. So this clearly indicates the risk of losing money on the sale of auto fuel, considering that we are already entering into the election zone. So in that zone or period, government will unlikely to rescue the OMCs. They will unlikely to take any kind of a price hike if the oil prices inches up from the current level. So in that scenario, investors will be definitely cautious, and definitely they will take a call on that side.
Let's break this down between petrol and diesel. In petrol, I think most of the brokerages also do believe that it's while this is unwarranted, it may not be too bad in terms of the timing of it. With diesel, though, I believe the bigger problem is there because their margins are hardly about breaking even. And with this fuel price cut, they're of course going to go into negative territory. So counters like HPCL stand to lose more than the likes of a BPCL, IOC, you'd imagine?
Among the oil marketing companies, HPCL is the most vulnerable to the fuel price cut. The marketing to refining ratio is the highest for the HPCL, and then followed by the BPCL, and least for the IOCL. So today we will see a major fall in HPCL, then BPCL, and then IOCL. So for layman understanding, every dollar per barrel change in a crude prices or product prices, oil product prices like the petrol and diesel, the changes in the gross marketing margins are 50 paisa per litre. But in case of HPCL, as we know, the marketing sales volumes are much higher compared to their refinery throughput. So we will see a kind of bigger impact on the HPCL stock price.
Kesh, if we do see a cut coming in, I mean, let's not forget that HPCL is already down 13% in the last 1 month. BPCL, of course, not too bad. It's down about 6 odd percent. And IOC as well has had it quite rough in the last 1 month, seeing a cut of 10%. If we do see a decline anywhere in the range of 5 to 8, maybe 5 to 10% over the course of the next few days, most people believe this becomes attractive, right? Because these valuations are not stretched. Would you go out and buy any of these counters in the current weakness in terms of stock reaction? And if yes, what would top your buying list this morning?
Okay, so the 2 points are there to highlight here. The after a correction, definitely it looks like that the investor will enter into the stocks. But before entering into the stocks, one need to look into the election scenarios. So the crude has already touched $85 per barrel. A scenario where any $2, $3 per increase in crude prices will start impacting on their marketing segment negatively. So again, that will be a worry in the investor's mind. Is it the right time to enter into these stocks? So I would suggest at least for next 2 to 3 months, which will be a kind of volatile period if the crude price inches up. So I would suggest that not to enter at these levels. Wait for a clarity from the side of a government. The government will not again intervene into the prices of petrol and diesel again. Secondly, complete deregulation. I mean, on the paper we have seen the deregulation of the petrol and diesel prices, but the prices were on a freeze since May 2022, and yesterday only the price cut we have seen. So just wanted to get some clarity that the government will not again intervene and cut down the petrol and diesel prices and the complete deregulation of the petrol and diesel prices. If these two things get little bit clarity, then only I would suggest to enter into the stocks at this point of time.
Not going to be price sensitive in terms of entry point. That's what Yogesh is saying. Clarity from, of course, the government is what's going to drive these counters in terms of buying interest. But Yogesh, thanks for joining in. Great to get some perspective on what this fuel price cut means for OMCs and investors too. Well, that's, of course, the reaction coming in on OMCs. I think HPCL is probably going to be worsted in today's trade. A big gap down cannot be ruled out.
You know, for the longest time, what I find interesting about the developments yesterday is for the longest time you had a clutch of brokerage notes saying that this government is not going to cut prices before elections because they're confident about winning. It's not going to happen. And well, I think there are some very basic checklists you have to go through before you prep for an election season.
Yeah, the only question is, the only question is if it has a gap down today, is this the bottom? Because it's a token price cut. This is it. Now nothing more can be done. Can the stocks reverse, or can this be the bottom? That's the only question, because as Samina highlighted as well, the stocks have already fallen a bit. If there is a gap down further today, at some point
becomes
of time,
a buying opportunity.
Valuation comes in.
I think HPCL may not see that valuation play only because diesel is the problem, but BPCL usually turns out to be lead in terms of OMC play. But I guess we've got our other guests as well for lots of stock reaction.
Let's get Kush, Bohra in. Avinash, Gorakshakar, exciting morning. Welcome to both of you. And great to have you this morning on NDTV Profit. Kush, let me begin with you. We'll just jump in straight to what your calls would be today, because so many things have changed since closing yesterday and where we're setting up for opening today. So I'd be curious to know what would be on your top calls list.
Hi, Tamanna. First, a very good morning to you, to all the panelists and all the viewers. And I just have to, ask, I mean, was this a color coordinated? And has Niraj already made a mention of that? Is the outfit reflecting the market sentiment? But my calls actually pretty much remain the same.
No, Kush, I agree. If the market falls today, blame it on these two women here.
No, we're cheering. We're cheering for, red as, the color of excitement and energy in the markets today. It depends on which way you look at it. But
Anyways, Kush, over to you.
The bulls and the bears. That's the only place I will say the red, the red color looks good. So not anymore in the market. So look, my calls remain the same. Geo Financial Services, we've been gung-ho about it for a while and has done wonders. We are quite bullish on this from here on. This tip might turn out to be a buying opportunity, from let's say a couple of weeks from now. So 350, 365 are our near-term targets. 325 is where we'll place a stop loss for a trading bet. Siemens is one stock again that we've been very bullish on. This stock hasn't really participated in the downfall in a meaningful way. It's just consolidating back to with a positive bias. So 48.50, 49.50 are the targets that you can look at. 46.50, is a stop loss that you can place from a trading perspective. And even before you guys get there, Swan Energy is one stock that we've discussed extensively and has taken a beating. My suggestion here, if anyone's still holding this, is to continue to hold on to this. Do not sell a lot of these good names in panic, that we're seeing in the market right now. Hold on, your waiting period might get a little longer, but I don't see a reason to sell in panic and get out immediately.
Okay, so Swan, you're holding on to. What would you do with Electra this morning, Kush?
So Electra Green Tech, well, this stock's actually seen a fair bit of volatility. The move's not really been as convincing. However, it's very close to the support zone. 16.50 is the support zone. It's taken support there yesterday and day before as well. So I would hold on to this one and I'll place a positional stop loss at about 16.50. I don't expect a great degree of momentum, coming around, probably some profit booking at higher levels, but I'll hold on to this one with a positional stop loss of 16.50.
Avinash, first calls from you on what is the biggest factor this morning. Is it OMCs getting hit because of fuel price cuts? Is it stress test? Is that a factor at all? Are you going to be looking at the electoral bond fallout?
Yeah, good morning, Tamanna. I think the electoral bonds issue is something which the markets would be closely observing. I think you mentioned about Electra Green. I think, its name figures quite prominently in the donors, to the political parties. So I think, clearly markets would definitely look at this very closely. Although this is a normal activity, I think these names coming in ahead of the election is definitely not a good sign. Our sense is that the markets would like to have more clarity on this. And clearly, I think, the mutual fund stress test is also a very key factor. I think Quant Mutual Fund has already pointed out that they are pretty safe. They were one of the few funds to actually come out with the results of the stress test. So my guess is that, the oil marketing companies are unlikely to move down further because, as you rightly pointed out, a major part of the correction has already happened. And I think this was expected, from the government ahead of the elections. So I think despite the fact that, companies like HPCL could take a more bigger hit, I think companies like BPCL, IOC, I think would definitely figure prominently, if they come down further, I think good bets in the medium to short term because, the consuming sectors like aviation, automobiles, the throughput has increased significantly. And I think most of these companies have benefited from softer crude prices. So I think going forward, there could be a soft dent on their profitability, but nothing so major. But I think the electoral bond issue, Tamanna, could be a key element which could figure out in the early morning trade. And we'll have to see how the market, digests all these numbers because many new names, many prominent names. So I think clearly this is something the markets would like to discount. And obviously, it seems that possibly there could be a minor correction initially, and then probably the markets would recover. But I think net markets would now be looking at the kind of election schedule because the second list of BJP candidates has been finalized. So I think markets are awaiting now the election schedule, which I think which will set the tone for the markets going forward.
Kush, the big story is going to be OMCs. Do you have a trade there? If we do see a gap down on a BPCL, HPCL, IOC, would you be brave enough to short it for intraday? And if you're going to go long, maybe for the March series, what prices would you be watching and tracking today?
First up, I think I've mentioned this before as well. I've never been a big fan of the OMC space. They move, in trends and then just, give way. Now, will I go short? Perhaps on something like an HPCL. It's already below its 50-day moving average. I'll be keen to see, where does the, gap down opening, if all it does come in, which is likely, where does it happen? If it happens somewhere close to the range of, 480, 485, I think there's still a room on the downside. So HPCL is one counter that I will have on my radar from a shorting perspective, not so much on IOC and BPCL, but HPCL, that's one stock, that I will have on my radar from a shorting perspective.
Okay, short, interesting. Okay, let's revisit that at 9:08 when the gap down, I'm presuming there will be a gap down when the gap down is known. We'll revisit this at 9:08. Let's take a break on that note. We haven't spoken banks, so we'll try and talk about banks. We'll try and talk about Paytm and so many other stocks and news in just moments from now. Stay
quick look at the implied open before we get to the list of stocks that should be on your radar today. And it's looking like a tough day. 102 points down, possibly, is where we'll open on the Nifty. A confluence of factors could be the reason. I mean, take your pick, right? From global cues to stress test results for mutual funds and a view on what they're doing with their small cap funds and mid cap funds, how liquid they are, electoral bonds. There could be a whole host of reasons. But anyway, let's get you the information you need to make the right decision. Varsha joins in now with a list of key stocks to watch for the day. Yes, Varsha?
Good morning, Tamanna. So, few stocks which should be in radar, starting with Genesis International Corporation, where they've received letter of acceptance from BMC to develop Mumbai's 3D city model and map stack. Contract value is at 155 crore. Now, Veritas Limited is to be their consortium partner, and this contract needs to be executed within 18 months. Then we have Navin Fluorine International, wherein they've approved additional investment of 250 crore in their wholly owned subsidiary Navin Fluorine Advanced Science Limited, which was incorporated in Feb 6, 2020 for greenfield projects in fluorochemicals. As on March 31st, their turnover was 514 crores and profit after tax was almost 68 crores. And lastly, we have Shakti Pumps, wherein they've received LOA for 3,500 solar photovoltaic water pumping system, and this contract is received under Component B PM Kusum scheme, which needs to be executed within 120 days, and the contract value stands at almost 93 crore.
All right, thanks so much. So those are some few stocks to monitor. Mind you, for Shakti Pumps, it usually tends to react at the whiff of good news. Let's wait and watch if today is yet another day wherein the stock does that. Avinash, any thoughts here on a Shakti Pumps? It's not a very large order, but the stock has had a stupendous rally. For somebody who's invested, stay invested?
Yeah, I think, Niraj, one can stay invested here because, the order book trajectory continues to be very rock solid. And I think in the solar water pumps, they enjoy a market share of almost 40 to 45%. And the Kusum scheme, which has been formulated by the government, has been the trigger point for the kind of revenue and the growth which the company has recorded. This is a small order, so I don't think it's going to have any significant impact on the overall revenue and profits. But I think sentimentally, I think the stock could open up on a positive.
Okay. All right, the pre-open rates about to kick in, and you'll probably see reactions. None of these reactions can be predicted right now. Let's wait for the rates to settle. All we can say is that OMCs will probably start off lower. Paytm could probably have a bit of a reaction, and the other interesting bucket to look at could be banks. So just get the OMCs maybe very quickly just to see what the initial momentum out there looks like on the oil marketing companies. We'll get that, and of course keep an eye out for the banking stocks as well. Not a major reaction really thus far, but let's give them a chance to settle.
Let's give the traders a chance to short it before it goes down.
Well,
further.
if they can match rates in the pre-open, to be very honest. But yeah, I mean, let's see how it shapes up. But the pockets which had a bit of a bounce yesterday, I think it's important to highlight some of those as well. Kush, yesterday some of the economy-linked stocks came up very, very strongly after correcting viciously on Wednesday. So you had some metal names which had seen some long unwinding come back yesterday. The Adani twins were the top gainers on the Nifty yesterday. So some bit of a bounce in some of the economy-linked stocks yesterday. Anything that stood out for you?
The one thing that stood out was that perhaps this could be a relief rally or a relief kind of a bounce. Most of these names, despite the kind of sharp, up move that we saw, weren't even able to cross, the Wednesday's low rather, or by Wednesday's high rather than, that they had made, or in some cases key averages, that these stocks have traded below. So from my perspective, this was more of a relief rally. We were tracking a lot of names, and this is one thing that came across. So I will wait before I, perhaps consider a buy on dips on certain, some of these names. So for me, taking out certain key levels on these names is a little critical. Yesterday was more of a relief rally, so I'll just wait and watch, for some of these names if this bounce is sustainable or not.
Okay, well, but some of those stocks certainly did well for themselves in the session. Now, I'm just trying to think of what stocks, right? There is HDFC Bank and other banks, and the inflow that might come in today. Could these stocks show a bit of a bump up? I'll watch out for Sundaram Clayton because amongst everything else, Govind Parekh has bought about 5.35 lakh shares, and certain names invoke some response, and this one could be interesting as well. And Gopal Snacks, first day of the listing, Quant MF bought about, I think the AMC within 2 schemes bought over 15 lakh shares at 374. The stock was down yesterday, maybe active today. So a couple of stocks could be interesting.
I was just looking at the stocks on my watch list that I've kept. RailTel. Look at RailTel this morning in pre-open and how it's doing. Paisalo, Swan Energy, RailTel is 10% up. Good day, second day in a row. Paisalo is 8.5% up. Swan Energy, Kush was talking about it with a smile, 4.5% up. Paytm, let's look at Paytm. We were talking about the overhang sort of behind now. At least when bad news is done, it's done, right? So 5% up this morning. A complete re-rating. The business model has changed. Nevertheless, a Suzlon. So some of these very, very initial trends, frankly, just the first few minutes, so can't say much. But at least what can be spotted is more of the same when it comes to yesterday. Not really a change in momentum per se. On the market in terms of what we were seeing yesterday, even an IRFC, etc., is not doing too badly at all. Kush, would you be looking at some of these rail stocks, these core economy and government capex run stocks this morning?
So for sure, something like a RailTel or an IRFC, from a technical standpoint also, they've perhaps broken, below certain key levels. But, if I look at something like a RailTel, 300, 310 was a strong support zone. That's where the stock perhaps, slipped to and is rebounding from there. IRFC also, if you see, seems like on a fairly strong footing, obviously on a relative basis. So here too, I think there are some pockets that will emerge. My only concern, Tamanna, as I just mentioned, is that, even if today is the second day of, the green shoots that we're seeing on, some of these names, whether this rally in the coming days is sustainable or not is what, I have my concerns about. Even if, that doesn't happen, I think these stocks are off their highs and perhaps warrant, a fresh allocation. If someone's looking at a fresh allocation, then not a bad idea to, start putting in some money at these levels.
Okay. Well, watch out for some of those. Okay, LTTS could be an interesting one. They've signed an MOU with the government of Maharashtra. They've secured a $100 million program in cyber security. Now, this is interesting, and therefore, maybe this stock too, who knows, may react a little bit. So keep an eye out for this one as well. The ER&D stocks, Avinash, Gorakshakar, do you like LTTS, KPIT, etc., or are there better bets to bet on?
No, I think, Niraj, within the given space, I think KPIT Technologies looks to be quite attractive, from a longer term perspective. Not only do they have a very good order book, but I think the kind of commentary the management has given, I think, is quite reassuring. My sense is that L&T Technologies also should do well. But in terms of the price and the risk reward, I think KPIT Technologies could definitely give a better kind of risk reward if one were to take a 12 to 18 month view. I think this space is a niche space. Margins are good. And, some of these companies, which are in the space, the larger ones like L&T Tech, KPIT Tech, they have got significant amount of order book, which should give them good revenue visibility for the next, say, 12 to 18 months. So I think KPIT Tech looks more interesting. And we have been advising our clients to actually buy this stock on every decline. Very strong business model. And obviously, over the next, say, 12, 18 months, we could see a further re-rating.
Kush, what is the trade amongst defense stocks? HAL had bagged a big order, pulled back also quite well yesterday in terms of trade. As we step foot into today, how would you play BDL, HAL, BHAL? Is there an opportunity there for traders today?
For sure. BDL, I would perhaps wait a little bit on, but the other two names, BEL and HAL, are a very clear, buy on dips for me. The kind of, fall that these stocks had seen, even that wasn't as, exaggerated. They're taking support at, just the right levels. For example, HAL is taking support at, the 50-day moving average for the last two sessions. So I think these stocks are a very clear buy on dips, in my book. So as I said, HAL, BEL, these are the two stocks that you should have on your radar. BDL too, but, it's slightly delicately, poised below certain averages and very close to the support zone. So from that perspective, I will just wait for perhaps for a session or two to watch. But HAL and BEL, continue to stand out and, remain a buy on dip.
BDL, HAL and BEL, but HAL and BEL remained stocks that, of course, Kush is tracking in trade. Well, along with that, as pre-open is showing some signs of settling down. Let's take a look at what's moving. Kush, correct me if I'm wrong, but I think Swan was one of the stocks we've talked to you about in the past. Expected to see another big gap up. Fundamentally as well, there were a couple of big funds that bought into Swan in the month of Feb. The 5.5% uptick expected today, how would you play Swan?
So, Samina, hence, even before you asked, I made a point to speak about it in my opening comments. I will continue to hold on to this one. Sometimes the higher they go, the harder they fall. That's how, this stock has actually played out. Was into overstretched territories. Of course, the fall is quite deep, and anyone who's entered last might feel, the pain here. But as I said, continue to hold on to this one. If you want a positional stop loss and it comes a little deep at 480, but otherwise, I would suggest, continue to hold on to Swan Energy. The waiting period might get a little extended, but I think, the stock will perhaps, eventually get to those 750, 800 levels in the coming months.
Kush, no fresh buys on Swan Energy.
Well, the same thing that I mentioned about a couple of other stocks. Yesterday was a bump up. Today also we are seeing a 5%, gap up opening. My only concern is, whether this move is sustainable or not. And hence, and plus I'm not a big fan of averaging. So I don't really, suggest averaging. And once we're very clear, once we're in the clear that, the rally is sustainable, the worst is behind us, perhaps I wouldn't mind averaging at a slightly higher level also. But just for a day or two, I would like to wait and watch. Who knows, perhaps the Friday effect might also start, playing out today. Some profit booking might kick in. So I'll just wait and watch, perhaps, for a day or two. If the rally does seem sustainable, I wouldn't mind going out and buying at a slightly higher level also.
Right, Kush, and stay with us. We'll come right back to you. But over half a dozen fund houses have declared the results of the stress test for the small and mid-cap funds. Alex is joining in with more details on that. Alex, what does the data say? It's looking too bad, looking okay?
So it's a mixed bag, Samina. And in fact, we'll have to talk to a lot more people to kind of get a sense of what is good and what is bad. This is a first of its kind stress test. And in case you're wondering what this is all about, this is essentially measured, or it's a measure to tell you how long it would take for a mutual fund to liquidate its stock portfolio. And the method to do that is that you take the 80% most liquid stocks, you multiply the daily traded volume over the last 3 months by 3, and you only take a 10% participation. You calculate how many days it would take to liquidate your entire portfolio of the 50% and the 25%. So that's the context. I have decided to speak about those that are taking the most time to liquidate half of their portfolio, and there are a few names here. On that list, you have DSP Small Cap, which has an AUM of about 13,700 crore, which is going to take 32 days to liquidate half of its portfolio. You have Quant, which is 22 days, which is among the larger players, or rather the ones that are taking the most time, the least amount. You have Nippon India, which is the largest small cap fund, which is going to take as many as 27 days. And you have Axis Small Cap Fund, which is going to take about 28 days. Now, one thing that we need to get clarity on is that this, according to the calculation, relates to the number of stocks in the portfolio and how much time it would take to liquidate those stocks. But then separately, these AMCs are also disclosing how much cash these schemes have. So for example, Axis, which is going to take, 28 days, if I'm not mistaken? Yeah, 28 days, has 10.7% cash in the small cap scheme. So these schemes obviously are going to be able to use cash as well to liquidate certain positions. Let me very quickly take you through the mid cap as well, if we can go to the next slide, because that is also going to give you a picture. And broadly, this is a better scenario. Of course, at the bottom of the screen, you have DSP once again, which has the most time. I'm hearing from the AMC that they're going to put out a note very shortly to try and explain some of these metrics. But long story short, guys, this is essentially a stress test. It is something that is a hypothetical scenario. How these things will pan out in reality and whether or not they face a situation like Franklin is another matter. But it's supposed to give investors an idea of how to deal with a situation like that.
Thanks, Alex, for that. And two things out here, viewers. One, for a lot of funds, the number of stocks and the AUM would also play a part in the number of days they would take to liquidate the larger portion of their portfolio. The exception out there is Nippon Mid Cap, which is lower on the days, despite the fact that they've got a higher AUM, part one. And part two, for a lot of funds, if they're true to label, and which is that in the small cap fund, they do not have many large cap stocks, then it's more difficult to liquidate as well. So that's to be kept in mind. Having said that, very interesting data and more analysis during the course of the show. But we have only 2 minutes left, so it's important to highlight what's happened. Sorry, you want to make a point?
Yeah, no, just the fact that the stress test will be seen, at least initially, with some trepidation. All of this will take time to sink in, that it's not going to happen. There is a very rare chance that you will have up to 50% of redemptions.
Yeah.
But the stress test was put in there, in place, and asked for a reason, to keep them on their toes.
Yeah, I mean, but I don't know. I disagree with the term trepidation, Tamanna. I really don't think these results are too bad. These results are fine. For most houses, they are fine. Maybe one or two odd houses, one or two odd schemes. Otherwise, for most houses, they seem to be fine.
There's only one on that one. There's only BSP that's out of the 20.
And their argument, I have spoke to a couple of guys, and their argument is that if for funds who've got large cap stocks in their portfolio and the true to label fund then comes into play, they are saying that we had more true to label than some of the others. Therefore, we have a larger proportion of these small cap stocks. Now, again, you can slice and dice it.
Which is arguable, right, Niraj? Because if 65% is the minimum small and mid cap exposure you have, if you have a fund that's 80 to 85%, which is truly small and mid cap, will of course have that struggle. And very few investors would have only one fund or only one sector or only one market cap in their portfolio. So I think going back to the drawing room and taking stock of what your portfolio at whole looks like is more important than pinpointing and getting concerned about the number of days that you would need to liquidate 50% of your portfolio. But like Alex also indicated, this is a case study more than anything else. But over to you, Niraj. We're gearing up for not too bad a morning, but 22,000 will become important in today's day of trade.
Most certainly. 20 seconds left for the markets to kickstart trade. Those levels, important to watch. Both Samina and Tamanna highlighted some of those. We have 20 seconds left. Maybe Kush, very quickly, 10-second answer. That one top stock on your radar today.
Because it's a Friday, I'll give you two. Geo Financial is the first and Siemens will be the second.
Okay, the same stocks that Kush highlighted at the start. He's sticking to them post the pre-open session. We'll come back to our guests post-open, but here's how the markets are starting off. And let's start off with how the large caps are doing. Remember, the implied open was suggesting a very deep gash. We don't have as deep a gash, but let's see if this worsens. For about 80, actually almost in line now, 90 points, between 90 and 110, no difference mainly out there. Banks about 1/3%, so no recovery out there. Yesterday were down, today are down. Mid caps about 0.4%, small caps down about, actually faring a lot better. Mind you, the globe isn't a happy place today, so that's to be kept in mind too. But let's get the heat map up on the screen and show you what's moving and what's not. Well, overwhelming red, by the way. A lot of red, very little green. Actually, nothing in the green worth talking about because it's maybe a few defensives with a couple of Adani twins there, Adani Enterprises and Ports, but hardly anything out there worth talking about. The losing side, BPCL, 3.5% downtick. Coal India, Grasim, Axis. In fact, IT, which made this attempt to make a move on the upside yesterday, has again corrected today. IT is actually not going anywhere. I dare say I don't have too much to talk about. Tamanna, maybe get you in the scene because the large caps are dominated mainly by BPCL, which is down, a Coal India, Grasim here and there, but a lot of red. Very little green. Maybe, Tamanna, you could argue a power grid now is building on, and Adani Enterprises after yesterday's 6% up move, another 1% up move, but otherwise, an okay kind of a start.
So, that's what I mean by a bit of wait and watch. People are wondering which way the wind is blowing as more information is coming, because on all the events we've talked about this morning, there is more to be unraveled and seen, whether it is details of who's bought electoral bonds or what the reality of those stress tests are, and we're going to be on top of that. But let's quickly pull up the broader market indicators before we get to specific stocks. I just want to see what's happening with the mid-cap 150 flat. Small cap index and micro cap is also what we can pull up because this has been pockets of pain. Nothing too much on either side. And even the micro cap back will have 0.5% up, but then it had also been cut the most. I'm going to pull up all of your OMCs, and some of them have been addressed by Niraj as well, but HPCL, BPCL, IOC for one. And only because there is a clear reason for some pockets of pain. Now, the question is, after a point, will there be an understanding that this is just 2 rupees and this is it now for quite some time? The larger trend of the government has not been to, pare down retail prices at the cost of these companies' balance sheets. I don't know. I don't know if that'll happen, but right now the morning's been tough. Electro Green, only because we've been speaking about it. Mega Engineering, its parent, is the second largest buyer of electoral bonds between 2019 and 2024. That stock about 2.5% down. Again, not massively, frankly, with the kind of news flow. Paytm, at the end of the day, nothing great is happening for the company, but the worst may be over. It's been a rescue mission by a clutch of banks coming in for their UPI business. Their TPAP license is through from NPCI. They're going to sort of change who they are. They're now a payments gateway like a Google Pay largely. Nothing more than that substantially. So a bit of remaking, but that stock 5% up because the overhang at the end of the day is over. Swan Energy and Biocon, just the other two that I'm going to talk about. Swan Energy has just been on a roll the last couple of sessions, apart from the day when there was a big hit across the sectors and the broader markets. But Swan Energy, Kush, Bohra's pick 7.5% up today. Biocon's the other one. The Biocon Biologics business has been sold. We'll try and get more details on that through the day as well. That came in last evening, 2.5% down. The street's not taken it too well. But Samina, what's on your list?
Well, it's not doing too well or too badly, but Swan Energy, like we talked about, 8% up move this morning. So if you're sitting long on that one, you're probably laughing your way to the bank. Another 8% gain coming in on Swan Energy, and that is turning out to be your top gainer in trade. BLS International, after 20% up move yesterday, seeing another 6% gain this morning. So there's no stopping this one either. 7% almost on BLS International. 197 Communication also seeing a big move, 5% higher. Campus Activewear is trading with a gain of 5%. IRB Infra is up 4% on back of an auto win. On total collection numbers that came out. Endurance is up 4%. Macrotech continues to do well. Zomato, Delta Corp, KPIT Tech are not doing too badly. Phoenix Mills, Max Financials are all trading with a gain of 2.5%. So broader markets actually doing pretty well despite all the concerns and worries we had. The street really moving on, and it was a sell. It was really, I guess, sell the rumor, buy the news sort of a play out that we're seeing on the street. Benchmark is well trading close to 22,100, but it is the broader market that was looking stressed, continuing to gain for the second straight day. IRB Infra is up 4%. Like I said, on the sell side, it's another bad day for Tata Investment Corp. After seeing such a sharp move over the last few days, this counter is getting beaten down. Pretty much, it's been the third straight day rather, of lower circuit on Tata Investment. The stock trades 5% lower. OMCs, we've already highlighted those for you, but the losses aren't looking as bad as we'd have anticipated initially. HPCL, which is down 13% in the last 1 month, is seeing a cut of 3%. Now, like Niraj and me were discussing, the fact remains that these stocks have already sold off quite sharply. So some of this price cut could probably be in the price, and these counters may be getting lapped up now after the recent price correction. Electra, Tamanna as mentioned, Biocon has been mentioned. Apart from that, PB Fintech is down marginally. SJVN, Infosys, Godrej Consumer. So I think I'm taking heart from the fact that there aren't too many losers in the broader markets, and the losses are not very deep.
Real estate is recovering. Real estate is recovering. So
it definitely was sell the rumor, buy the news.
Yeah.
I mean, I think all the overhang is done with. We can look ahead and pretty much take a call on technicals and fundamentals as opposed to just news flow that's more macro in nature.
So macro tech, Phoenix Mills, eyeballs is just what I want to highlight because, that's the index is about 1.5% up. So in a, I would say, tepid kind of day, at least some movement over there. Even media stocks are not doing too badly.
About time for
media. This is, fundamentally look at it. This is the season for media companies. When you have elections or big events around the corner, that's when, revenues come in.
No, just one other stock which we brought up in the trade setup as well. Sundaram Clayton and Shakti Pumps. So Shakti Pumps, not a very large order, but maybe reacting. No, this is TVS Holdings. There is Sundaram Clayton, the stock, which has gained quite significantly today. So watch out for that one, 6.5% higher for that. And Shakti Pumps is up 5% as well.
Upper circuit on that one. That one's been on a roll, and you've had a couple of big AIFs and PMSs, in fact. And we spoke with Sumit Nagar a few months ago, and he was query optimistic on this one. So that counter clearly doing well, going in from more of a local play to a nationwide play for Shakti pumps, and that's playing out well on the counter. Well, all in all, it's actually not a bad setup, and this is a big Friday relief coming in for the street. Kush, any top spots in the last 5 minutes of trade? Real estate, like Tamanna said, is recovering. Would you play any of those stocks for a recovery today?
Oh, absolutely. BLF is something that we've had on our radar for some time. Godrej Properties too. So we look at some of these names on the rebound. So Godrej Properties, if if you don't have a position, now might be a good time to enter. The positional stop loss comes in at 21.30, and the targets could be 22.70, and one that is taken now 23.50 also. So Godrej Properties does look strong. I think one conversation that perhaps I missed at the start of the show was on Bank Nifty. There are more than a handful of factors to suggest that there is a long trade perhaps emerging in Bank Nifty. It's taking support at a couple of levels, a couple of strong levels. HDFC and Kotak are starting to do well. Already there was a bit of underperformance. So I think Bank Nifty, for some brave hearts, is a long from here. The positional stop loss will come in at 46,400, and immediately 47,200 and 47,700 would be the target. So perhaps that's a conversation that I should have had at the start of the show itself.
Good. We'll unfortunately have to call it a day right now with Avinash and Kush, because we need to slip into a quick commercial break. Gentlemen, both of you, thank you so much for taking the time out and being with us. Avinash, thanks for waiting by. Sorry couldn't come for an opening comment, but have to slip into a break. But don't go anywhere, because stress test results are very important. And up next, we have A. Balasubramanian of MD and CEO of Aditya Birla Sun Life AMC joining us live. Stay tuned.
Welcome back. You're watching India Market Open. Vimal Kejriwal, Managing Director and CEO at KEC International, joins in. Remember, the stock has been in focus, catching a lot of attention of investors and traders on back of big order wins. And of course, let's not forget a spectacular set of earnings that were posted by the company in the third quarter. Mr. Kejriwal, good morning. Thank you for joining us. It's actually looking really good for you. The last 6 quarters have been fantastic. Last quarter numbers have caught everyone's attention. And now you've gone out and bagged another big order to the tune of 2,257 crores. Tell us, what vertical is this? Is this TND or non-TND? Where does this take your order book? I believe there has been an upside risk to your revenue guidance as well.
Good morning, Samina. Thanks for having me. So largely this order is, I think, almost 80-85% is from our transmission vertical, and the rest is spread across, cables and civil. Also, on the revenue side, we have been talking around 20,000 crores, and I think we should be somewhere there, maybe 100, 200 crores here or there, I don't know. But we should be close to our numbers, which would be roughly around 16-17% growth to our last year number, which again were at 16-17%. So I think we are doing well on the growth side.
Kejriwal, quarter 4 is historically a very strong order for order wins. And I believe if you can share with me your order pipeline as well, what you bid for, what is the conversion that we're expecting from those order wins, and where will fourth quarter or the start of next quarter stand at in terms of incremental orders?
So I think the issue is that this year it may not be as great as it always is, because, and typically what happens is most of the orders come in the last 15 days. Now with the election, code of conduct almost around the corner, whatever has not been ordered. Code of conduct applies every. So, if you look at yesterday's announcements, we announced, some of our competitors announced, so most of the people got orders from Power Grid and, others. So I think the number would depend upon how soon the code comes and how quickly people, let's say we are L1, like even today we have an order L1 of almost close to 5,000 crores, of which some are from government utilities. So if they are able to process and give the orders before it is announced, whenever it is announced, I think that will impact. We have some. So in all, we have around 5,000 crores, as I said, partly from government, partly from private, and some from international. So we are still hopeful that some more things will come out from non-utility. As far as first quarter is concerned, I think till May end, I don't see much orders coming in from the government sector. But we have bid for a lot of tenders in the civil side and international, and we do hope that things will, start moving at least that side, and we should get some orders.
Kejriwal, can you quantify the order pipeline for me?
So if you look at the tender, I'll say the tender pipeline today is almost 110,000 crores of tenders, which we have either quoted in the recent past, which are not yet opened, or which are to be quoted in the, let's say, next couple of months or two or 3 months. So it's around 110,000, of which around 55, I'll say around 60,000 is from the transmission sector, both India, international, which includes our SA Americas, and the rest is between civil, renewable, and railways.
Right. And what is the conversion in terms of order historically to revenue? If 110,000 crores is what you're bidding for, how much of that will mature into revenue or orders? Historically, I know it's tough to call out what's good looking ahead.
So typically we have been getting around 15-16% of what we bid. Okay. Or I'll say 1 out of 6 is what we typically look at. So out of 110,000, which is there today, hopefully if we win 15%, maybe 15,000 crores should come out of this tender pipeline.
So Kejriwal, I want to talk to you about margins because I know historically margins were slightly under pressure because a lot of those legacy projects were not completed in that sense. Looking ahead, India and internationally, it seems like it's a supplier's market because the orders are coming in thick and fast, and there are only that many players like yourself that are bidding for these projects. What is the view on margins? We've seen an improvement in the third quarter. Is it fair to assume that you would go back to levels of 8% on EBITDA margins, or that looks a little far-fetched over the next few quarters?
Our expectation is that next year, I'm saying for the full year, FY25, we should be anywhere between 7.5 to 8. So it is not far-fetched. Okay. So I think we expect that, anywhere between 7.5 to 8, depending upon, what happens on the supply side and other issues. We should be close to that. And Post that, I think next year we will finish all our legacies orders and all. So the year after FY26, I think we are clearly targeting to reach double digit.
And sir, the new orders that you're bidding for are coming in at better margins, you think, or that you've closed are coming in at better margins? So is there an upside risk from 8% going into next year?
It would depend upon which orders get executed, number one. Number two, what you said is right in the sense that there are orders which are bidding at I'll say, higher margins. So it's not that, the whole piece is going up. It's, order to order, client to client with competition, what is happening, etc., where the margins get stacked up. But clearly there is an improvement in the margins at which we are bidding.
Mr. Kejriwal, I did read about the fact that businesses roaring in the Middle East. So countries like Oman, Saudi, are adding capacity in some of those Middle Eastern countries. What is your export order book? Is it healthy currently? Big order wins there expected? And also, are those export orders at better margins?
So if you look at our, let me give an overall picture of our revenue. Our revenues this year will be around 20,000, of which around 30% would be outside India. The 6,000, 6,500 would be outside India. But if you look at the breakup in transmission, more than 60% of our order revenues come from international. India is higher because of our civil and railway business. So already we are at around 60-70% of our revenues for international come from the overseas market, especially Middle East and Americas. Clearly, Middle East is doing very well. And I think our order book in Saudi itself is more than $500 million. And right now we are all in T&D. We just announced our first oil and gas order in Africa. So clearly we are seeing that international will definitely grow, especially the Middle East and the Americas. But the growth in India, I think, is far outpacing all other growths.
It's a problem of plenty in that sense, right, Mr. Kejriwal?
Yes, you're absolutely right. I think, yeah.
Right. I want to talk to you and understand about these supply chain pressures, and I heard a couple of your interviews where you said that there was some supply chain pressures that we were facing, and I do understand that may not have a direct impact on margins, but it's going to delay projects or delivery in that sense. Do you anticipate delays in that sense, your orders converting into recognizable revenues then in the next couple of quarters? Is there a downside risk there?
So we are talking about a 15% growth next year from the current 20,000, which we anticipate to happen. So that should be roughly around 23,000. We have an order book of around 30,000. We have an L1 of close to 5,000. So typically we have seen that our conversion would be from, order book to revenue, or it will be 1.5. So 30,000 crores should translate into 20,000 crores of revenue. Plus, we should have a lot more order wins which will happen during the year, and especially orders which come in Q1 or Q2 will get translated into revenue. See, unlike some of my peers and competitors, we are still not in heavy civil or items, projects which are running into 3 years, 4 years. My projects are typically, all between 18 to 24 months. So I don't see any downside risk to what we are talking in terms of the numbers or order book to revenue conversion. Coming to your question on supply chain, yes, there has been some pressure happening, and I think it's because you also mentioned the problem of plenty, where suddenly we are seeing a lot of orders coming. I've never seen so many orders coming in India T&D. Our India T&D order book and order intake is the highest ever. So clearly there will be a pressure because 2 years back, this industry was suffering very badly. So people had downsized and people had not added capacity, which they are now doing. So our view is that, probably in H2, we should have a easing of supply chain. People are adding capacity. And so conductors has been the biggest issue. Now we are adding our own conductor manufacturing. Then I think the other item which has been on short supply has been transformers and GIS, etc., where we are now seeing government looking at relaxing some rules, etc. So I think in H2, the issue should get resolved. There has been a little bit compounding because of the Red Sea impact, where supplies are getting delayed from Europe or to Europe, which I think it's a matter of time, a month or two, it should hopefully get eased out.
Right, Mr. Kejriwal, it is so good to talk to you. And of course, it was great to know that times haven't been better and it's a problem of plenty. I hope and wish you luck. We'll hopefully connect with you soon again, hopefully when the fourth quarter earnings are out as well. But good luck until then.
Thank you for having me. Thanks a lot.
Well, that was the manager of KSE talking about how it's a problem of plenty and they've not seen more orders in their life. That's how great and good it's looking for KSE. But well, I'm going to quickly toss it over to Murli Swaminathan. He's joined he's talking to A. Bala to discuss more about the stress test results.
Thank you, Samina. Let me welcome A. Balasubramanian, MD and CEO, Aditya Birla Sun Life. Good morning, Bala. Thanks for joining us.
Yeah.
Okay, so my first question is, how stressful is this stress test for mutual funds?
It's not that stressful, given the fact that we have been working on this stress test discussion for quite some time. One as an industry body, there is a committee at AMFI, which is comprising of CIOs and equity, head of equity. Have been working closely with the risk management team of respective fund houses. There is a two committee that we run, and every time we look at anything that comes as potential steps one has to take to highlight the risk associated with the mutual funds. As you know, that mutual fund players have been, of course, saying for quite some time that the risk in smaller mid cap, given the fact that the price has been quite substantial, therefore valuation would have gone out of acceptable level. Therefore, one has to manage the risk. Also, given the fact that huge amount of participation has come in this segment of the market. Therefore, often we revisit the risk associated with such kind of movement, and the number that has been being disclosed today, this has been tested multiple number of times on the basis of what has been guided. Assuming on a pro rata basis, you have to sell if there is a redemption of 50%. Assuming you have to sell on a pro rata basis by 28%, then what the kind of number of days will take to liquidate, which is nothing but a stress test. But in fact, in reality, it doesn't work that way. I think in reality, when money managers liquidate the assets when there is redemptions, first he sells what he uses cash, then he looks at other assets which are sellable, then he looks at one month of the company's basis which he sells. And also this doesn't take into account the price. There are liquidities in the market. At what price you will see the liquidity of the companies will rise significantly. If there is a price fall of say 10%, there is high probability the volume of the companies traded also will go up by 3-4 times, though there is no evidence for that. But normally happens in a price fluctuation. Therefore, I would say that while it is the responsibility of the industry to highlight some of the risk associated with these kind of portfolios by giving these kind of numbers, but it is not something new to us. It is already being monitored internally by the respective risk management team of the AMCs. So now that it is coming in the public domain in one platform, this is something probably I would say is new to the industry. And it's again first time it's happening. Probably I would say this would be a welcome step in that manner.
Right. Okay. So from an investor's point of view, let me take this. We are looking at 10 days to liquidate 50% of your small cap portfolio. What does it mean for me as an investor?
There's only one number you have to look at. From investor's point of view, no investment is being made on the base of the stress test. The investment is always being made on the base of the segment of the market you make an investment, whether it is large cap, multi cap, mid cap, small cap. And then what is the purpose for which you are coming, which is a long-term investing. I think every investor, after taking into account these stress test numbers, whether he can get worried on the base of this, doesn't need to get worried as long as his investment time horizon is about 3 to 5 years. In general, most of the investors who are coming in the small and mid cap space, they are not looking at short-term gain of about say 3 months or 6. Somebody coming for 3 to 6 months and then looking at putting a large pool of money. Definitely, I would discourage not to choose these kind of schemes, going by the stress and so on and so forth. As long as he has a very clear thoughts in his mind that yes, I am investing money for not for 1 year or 2 year, I am investing for the 5 year, then naturally these numbers will look one of the number they have to pay attention, but not necessarily they have to base the decision on the base of this.
Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today is Pankaj Murarka of Renaissance Investment Managers. The case for a chat in today's show is simple. Is the pain in the broader markets likely to continue? Can the stress test actually result in further stress for these mid-cap and small-cap markets? And of course, Pankaj specializes in trying to figure out what are the themes that will be the next 5, 10, 15-year themes and which are not discovered by the market. We try and talk to him a bit about that. Pankaj, great having you. Thanks for taking the time out. Hope all is well.
Good morning, Niraj. Absolutely. It's a pleasure always to talk to you and your viewers.
Thank you, Pankaj. Pankaj, I'm throwing in a bit of a spanner in the wheels, if you will, because the last few days or the last month and a half has been marked by severe volatility and downsides that have come in at the broader end of the spectrum. Is this the end of the small cap story for the time being?
No, not really, Niraj. I don't think so. Just to put broader views in context, I firmly believe that we continue to remain in a bull market. Having said that, it's a matured bull market because this March, this bull market is now 4 years old. Bull market started in the middle of COVID lockdowns in March of 20. So what I would like to highlight is this is a matured bull market. In that context, I think, and given the fact that it's a matured bull market and equity as an asset class tends to be volatile, I think that's the nature of the beast. There will be volatility. Last year, calendar year 2023, we've had euphoric moves in mid caps and small caps. So we're seeing some pullback of that. Obviously, there are pockets of markets and more so in mid caps and small caps where there is a significant diversion or gap between fundamental valuation and stock prices, and there'll be a mean reversion. So I think we're going through that. I think it'll be a good and healthy correction in the market that we're undergoing. And I still think that the broader bull market from an equities perspective remain very much intact. My view is that we are somewhere mid-cycle in this bull market. So I still think that this bull market has a longer to go.
Okay. Would the bent of an investor like you who is adept at identifying long-term themes which are not known to the markets at large or not discovered well, would the bent of an investor like you be towards larger stocks now, considering that there is a bit of a pressure at the broader end of the spectrum, or not quite?
Yes. So from a relative value perspective, you're absolutely right that we find more value in large caps versus mid and small caps. Just to put in context, what typically happens in every bull market, and this happened in this bull market also, at the start of the bull market, so in March 20, when the bull market started, mid caps and small caps were trading at 20, 30, 40% discount to the large cap indices. Today, we are at a stage where the mid cap index and the small cap index are trading at premium to large cap indices, again, which is very normal in a bull market to happen. So obviously, valuations in mid cap, small caps are extended. From a relative value perspective, we find more value in large caps. Having said that, we find enough number of mid caps as well, or small caps as well, which are far more quality oriented with solid business models, and which will still do well over the next 3-5 years. So we find value on both sides, but on the relative value perspective, you're right that large caps looks more attractive at this point of time from a risk-reward ratio perspective versus mid and small cap.
Okay. Well, one more reason for stress in the mid-cap and the small caps, viewers, is several fund houses declaring the results of the stress test. Now, in case you're wondering what that is, Alex joins us with some very quick details of the same. Alex.
Absolutely, Niraj. So I was speaking to the chief risk officer of one of the mutual funds here just to get clarity on some of the aspects that were unclear. And one of the most important points, of course, is that cash is included in the calculation. The other aspect to remember is that what they're using to calculate this methodology is days to liquidity, which means that the 80% of the portfolio that they're taking, which is the most liquid stocks, how much time does it take for the least liquid of that to complete? So what that means is, suppose you get a day of 56 days to liquidate that 80%. You divide that by half and you get 50%, right? So what that means is that it takes you 28 days to liquidate the half point. I hope that I'm explaining this correctly. What that means is that you can actually have what is called a days to cash, which means that you can sell both your most liquid and your least liquid stock on an ongoing basis, on a pro rata basis, and you can liquidate actually on a daily basis quite a considerable chunk of the AUM. So the Chief Risk Officer was explaining that while on the face of it, some of these numbers might look stark, it may not necessarily present the exact picture on liquidity. They first of all can meet up to 5% in cash, and then on an ongoing basis 2 to 4%, 5% in some situations, they can meet basis selling on an ongoing basis, Niraj.
Thanks for putting that into perspective, Alex. Pankaj, you've got past experience of being such a large manager in a large AMC. Is this stress test a big nervous development, or is this something that is acceptable?
No, not really. I think it's a good development that the regulator is being proactive and asking fund houses to disclose some more statistical details about the funds so that investors have access to this information, and more importantly, they can take informed decision. I believe because there's been some of these conversations around big bubble in mid and small caps, I think there are pockets of markets obviously there where there could be fraud, but I don't see it being overall at the aggregate level there's a bubble in the indices. Indices can correct, but I don't see them collapsing or being the peak of the cycle or anything of that sort at this point of time. And the other thing I want to highlight is, see, that's the nature of the beast. Equity markets inherently are prone to bubbles, manias, and busts. They happen every decade. You get one such cycles because equity markets are driven by greed and fear. So some of those things will happen because that's the inherent nature of the beast. So I think the incremental information disclosure is pretty good because it gives investors more information at their hand or at their disposal, and probably they can make more informed decisions.
Got it. Pankaj, the other aspect is while people are betting on emerging themes, the most sure shot bet seems to be the ability to bet on where the pie is visible, which is the government's focus on capex, maybe manufacturing, and pulling all stops out, while private capex hasn't come in. So amongst the safe bets, if you will, valuation taken into account, would you believe that all things considered, it still remains this capex/manufacturing piece, or are you looking at other things being the number one priority for you?
No, so you're absolutely right. I completely agree with you, Niraj, that we are seeing a very strong revival or comeback of India's investment cycle. Primarily, obviously, public investments, or as you said, the government investments have been very strong. But I see very strong incipient signs of revival of private sector capex as well. And I see post-elections, we should see a very significant rebound in India's private sector capex because corporate balance sheets are very healthy. Corporates' profitability is at all-time highs. Corporates are making huge profits and they're sitting on balance sheets are delevered. More importantly, banks or financial institutions are in good shape and their balance sheets are healthy with strong profitability and low NPAs, which is important because they are the ones who want to fund the capex or investments through the debt by lending. So I think overall we've reached an environment where underlying demand in the economy continues to remain strong. Most of the companies are reaching capacity utilization which are north of 70%, which effectively means they have to start planning their capacity and execute those capacities. And I see that across sectors, sector after sector, in each of the core sectors, I see very strong investments. Also, as you rightly said, this is also driven by a revival of India's manufacturing, driven by China Plus One and PLI incentive, which the government is rolling out across sectors. So I think a combination of all of this, I think India's manufacturing revival story and the capex story or investment cycle story looks very compelling. I am firmly in the camp that all of us are underestimating the potential growth impetus out of revival of India's investment cycle and revival of India's manufacturing. So I think this cycle will surprise us on the upside big time.
Okay. Well, surprise big time. We're still in the midst of the bull market. It's nowhere close to over. Reassuring words from Pankaj Murarka. We try and figure out from him what else within this investing landscape is he constructive on in what is turning out to be a slightly volatile period for investing and trading. Stay tuned. We'll be right back. Back with Talking Point in conversation with Pankaj Murarka. Pankaj, we've spoken at length about some of the themes that you've liked. Now, the reason why it is important to rehash or highlight some of those again is because valuations may actually have become reasonable in some of the broader market themes for sure. So, post Q3, post commentary, post the shakeout in the mid cap and the small cap space, what stands out as numero uno amongst the emerging themes?
So while, as I said, Niraj, the whole engineering and capital goods space riding on back on investment cycle continues to remain one of our preferred themes or bets and companies within the sector, because we think some of the fastest growing companies of India over the next 5 years will emerge from that sector. Apart from that, we've been fairly positive on healthcare and IT as a sector, because we think IT is coming out of a prolonged slowdown of the last 18 months, and we see strong signs of revival of IT investments by global companies in the second half of this year, and Indian IT companies should be a big beneficiary of that. So we've turned pretty positive on IT as a sector. We like healthcare as a sector because we think the sector has done well in the last 9 months or so, but we still think that there's still strong growth ahead of the sector, primarily because pricing pressure in US is off the table. We're seeing significant price improvements in US generics market, and which will significantly benefit Indian companies. And we also think financials which have underperformed for a broader part of last year should make a comeback in the second half of this year. So these are some of the things or companies within these themes are what we like, Niraj, in terms of what we are owning. What we are underweight is actually consumers. We think the economy has gone through cyclical consumer slowdown over the last 12 months, and it got accentuated because of a poor monsoon last year. Probably it will be time to revisit it post monsoons in the second half of this calendar year. Having said that, the sector also had headwinds of very expensive valuations, and on top of that, when you have a cyclical slowdown, which is what we've seen, consumer companies have actually underperformed over the last 2 years. So we still continue to remain underweight consumers as a sector.
Interesting. When you're betting on IT, Pankaj, and you track this so closely, I find it difficult to debate with you at all. But the point is at least the recency of trends. I mean, there's this Naukri job speak IT index which showed the hiring. That is also not picking up. So what gives you this confidence about a change in trend at all?
Niraj, there is a very fundamental shift that is undergoing in the world, and which is probably we are maybe 4 quarters ahead of the cycle, and that's all driven by this generative AI. I think in my my professional career of 26 years, this is the biggest transformation that I'm seeing is going to take shape in the IT industry worldwide, and will change life for each and every industry and consumers all over the world. Businesses will have to prepare for that, and they'll have to make significant investments to transform themselves to meet the expectations of the consumers as consumers transform themselves, adopting AI solutions. So I think we are at a cusp of a point, maybe probably 4 to 6 quarters ahead, where we'll see the biggest investment cycle in IT sector, which will play out globally. I think this wave of IT spend that we'll see over the next 5 or 10 years, typically IT spending cycles, when you get a new technology, that wave lasts for probably anywhere between 7 to 10 years, which is what I've seen in the past with, let's say, the enterprise wave or the cloud digital wave and so on and so forth. I think this wave of IT spends that we'll see over the next decade will be bigger than any of the previous IT investments or IT spend cycle that we've seen in the last 30, 40 years in the world. So when I look at the IT industry from a slightly more medium-term to longer-term prism, I feel very excited about the prospects of this industry. As I said, we could be probably 4 quarters ahead of the street or of all of this actually translating into business growth for companies, but I think it's certainly coming. We as investors tend to take a slightly more medium-term, longer-term view. So we like to be 4 quarters ahead of the actual business cycle turning around. So we like to be slightly ahead of the street in terms of placing our investment bets, and then wait for that tide to turn and then reap the benefits of growth in underlying businesses. So which is why it's our DNA to be slightly ahead of business and investment cycles.
Okay, well, slightly ahead, and sometimes it pays rich dividends if you can identify it well. Remember, Pankaj started off his career as a tech analyst, has studied this space for 30 years now, or maybe more, and therefore understands this space slightly better than what most other people would. Pankaj, take a moment to thank you for joining in today and giving us your thoughts on the show. Much appreciate your time.
Thank you very much, Niraj. It's a pleasure as always talking to you.
Yeah, likewise. And viewers, thanks for tuning into this edition of The Talking Point.